In part because they thought the Federal Reserve was going to ruin things for George H.W. Bush. Ideally, what happens is the U.S. Treasury gets together with the Federal Reserve. They buy equity futures to try to slow the market pull down. Some people say it's a myth. Some say it's real. What are your thoughts on even having to convene this team?
I'm surprised that they did it because, like you said earlier, the fundamentals of the U.S. economy right now are pretty strong. I think what's really weighing on the market right now, last week was a policy mistake. There's no other way to look at it. Jay Powell, flubbed the ball this time. And I fully understand, the path of normalization. We need to unwind the balance sheet. It's coming down at about $50 billion a clip every month. But raising interest rates in the current environment, it just didn't make sense. Even during the press conference, Jay Powell referred to slowing global growth, tightening of financial conditions here in the United States, and inflation, the one half of the dual mandate, nowhere to be seen. Oil is down 40%. That's a deflationary force right now. I think the president
everything they look at is ex-oil and food and energy, right? So they will come back and say that doesn't matter. We are watching the markets. We're not there yet. But David, to your point, I just want to add to that. The one thing that we've never had was the Fed taking away accommodation, the $50 billion every single month that they're taking away from the economy that they had to put in during the Obama administration.
I think that what's rattled the market there is not so much that we have to do it. It's maybe the pace and the fact that we're on autopilot. And the Fed knows this was a mistake because they actually sent out Williams the following day to try to walk back some of the harsh rhetoric from the press conference, which was one of the most disastrous that I've seen. The market was going down about 75 points every time the Jay Powell spoke. So it was a bad week for the markets, and it has market historians making comparisons to all sorts of Armageddon situations.
All right, so according to President Trump, then, with respect to, Jay Powell, he's blaming him for all of this. Of course...
he's certainly the elephant in the room.
There's speculation that the Fed might even consider firing him. Of course, Treasury Secretary Mnuchin coming out saying that's not true. We already saw how the media lost its mind over the Mattis exit, even though, I think President Trump was elected in part because he said we were going to get out of Syria and Afghanistan. But be that as it may, we know that from a public relations point of view, that would be a mainstream story that would go crazy, and certainly a Wall Street story that wouldn't be too good.
Sure it would. And look, the president isn't wrong. I happen to agree with him. But the fact that the only thing worse than an independent Fed is a politicized one. So I think it would be a big mistake for the president to weigh in on this. Firing a Fed chairman without cause. Bad message for the market. I think the markets will react pretty severely.
The cause would be that he thinks he's going to tip the American economy into a recession, which wouldn't be the first time. Just so folks know, there have been 9 rate hikes since President Trump was elected. Prior to that, we went 126 months without a rate hike until December 2015. And even then, Janet Yellen was told by Wall Street it was a mistake because we had that real ugly first 2 weeks in January.
Again, it's not the direction, it's the pace. This is the end of a very long experiment. We have nothing in history that we can point to. So I think the Fed needs to rethink this. Maybe the pace is a little slower. The market is a pretty strong leading indicator and has a lot better history of forecasting the future than the Fed has. Fed's history in terms of forecasting global growth has been pretty poor. And right now, even though we're pretty strong, around the world, economies are cratering.
What do you make? When I got home late last night, I did some back-of-the-envelope stuff. If my math is right, according to Wilshire 5000, we're down $6.7 trillion in market capitalization since the late September highs. Almost $7 trillion wiped out. Listen, the tariffs have cost us $11 billion. So the economy is growing like crazy. How do you square these numbers? Something to me isn't adding up. How do we lose $7 trillion in 3 months of market capitalization?
It's a great question, and it is hard to fathom right now. I was actually trying to think, where is the actual bottom in something like this? And in the end, it's the value guys that step in and say, that's it, no more. You can make a case right now where it's 16 times trailing earnings. That matches where we were in 2013, and we touched those levels several times. I think the real line in the sand, the ultimate low for the market, if we actually get there, would be about 2,100. That would be 13 times $161 for 2000.